Testing 1, 2, 3. Sound check, everybody. Hello, hello, hello. Whoa! Way to go. Dancing with Disney, right? What a trade. Nice stuff. Wish every trade was like that. Hope everyone enjoyed. For those that are members, and you followed that, I couldn't help but that one, right? The only bad news is we weren't like all in. So, partial position. I always like to say that catching some is better than catching none or being all in on losers, right? So it was a nice trade setup. You guys that are here with me today, just to double check, is there sound? Number one. All is good. All right, this is a pug meeting, and what pug meeting is simply is person's user group. For those that send in questions ahead of time, we try to cover your questions. Obviously, I don't know if there wasn't enough of a notification, but this is like one of the rarities that I didn't get a lot of questions for this event. So what I would tell you, if you have a question right now, type it in the room. There's never a bad question. When it regards to trading your money and my methodology, there are bad questions like how old am I? That's the answer is none. Which is none of your business. Just joking. Come on now. Anyway, thank you all for attending in the pug meeting. This is a pretty wild market events. I think a lot of you guys are here because of the algo program, which we've made vast improvements on some of the issues that came across filtering out specific trades. Many of you are finding huge or better success with the compression stop program. And I think what the real essence of any trading system, and the reason I've got this chart up in front of you right now is because my experience at the Las Vegas Traders Expo, we had, it was ironic that the show was kind of geared towards Forex. I guess they had a big Forex sponsor for the show, so there was a lot of Forex topics. There was, of course, the natural options, because options is the big buzz thing, right? Not much as far as algo strategies and or trade systems, and ironically, nobody, even my bud Jeff Hirsch. I guess he'd be the only one talking about seasonality with the Stock Traders Almanac, but he was more talking about his fund and things of that nature. And it was kind of I don't know, it didn't seem to be as much as a traders conference as I was anticipating. However, a lot of the audience we had a lot of new people that came to visit us, and again, some old ones like Jerome. If you're in the room, Jerome, are you here with us today? I don't see him. See, I don't even see Jerome. Jerome had a bad an owie. He hurt his foot, so he couldn't come to the seminar. He really is an avid fisherman. And many of you know we did a 3-day seminar down here in Palm Beach Gardens, and I took a few select folks on my boat. We went out fishing, we didn't just go on a boat ride. We actually caught a fish, a mahi-mahi, about a 10, 11 pounder. Nice fish. So everyone had a great time. Anyway, moving forward, pug meeting. Why am I focused on this chart, and why did I just give you the rendition of the Traders Expo? Because I think I stepped on someone's toes when I said it's very darn near impossible to trade the euro currency because of the contraction, the historic, and I made this comment. I was speaking on behalf of the CME. Now, what I think some Forex people don't know, or at least if you can visualize this, when you go to a trade show and someone's speaking and there's this huge audience around, people say like, well, what's this guy talking about? There's, people crowds attract attention, right? And so I was going over the algo optimizer, and I guess there are some people there that disagreed with my statement, which was simply this: it's hard to develop an algo strategy and for day trading purposes in the euro currency because we are at, and I stated, a historic low daily average true range.
Pug Group. Basically, we are going over information on the John Person TradeStation Lifetime Package. So I generally go through a couple things, and I know today we're going to go through the Algo 17 version 18, V8, the Algo 17 V18. And again, a couple of the changes, and then most importantly, when do you get the most out of your program? So that's it. I call it, it's Algo 17 V2-18. That's the deal, Jay, and I'll share that with you in just a second. It was the latest launch release, and you can upload that or download that through the App Store, I believe. So therefore, I just want to go through and make mention, nothing's really changed on our main program, but just for equity traders, just to reaffirm, the person's market catcher in this radar screen format is something that combined with buy signals, as I shared with you this morning in the live trading room, when we take a scan, and mind you, this has been turned off, so let me go. I don't want to get too goofy, but let's just say, for example, if I take the scans from today or what we were doing in the trading room, is that if I can get the results up, and it's not going to allow me because we crashed and I got to redo it and I'm not going to go. But what we do is we take the results, and what I want to do is just simply go into my radar screen page, and what I will do is I will say, if we get a assortment of buy signals, the first thing I'm going to look at is there decent volume on the average volume. Now, my average volume should, if I'm didn't mess with things, be 10 periods. So basically for stock and swing trading, two things that I like. I like the 10 period point of data when it comes to an average of volume as well as ATR, because in stocks that represents 2 weeks, half a month, 5 trading days, you might be in a sideways condition. You may have had a big pop in volatility. And I think 2 weeks, 10 trading session averages out pretty decently. 20 might be too much. 5 might be too little. So for swing trading, I have found personally 10 period is the best for my analysis. So therefore, a couple of things that I want to look at is if we're going to figure out where the market's going to go, and a few moments ago, before we had a crash, I had this chart on the euro currency all teed up for us. So I want to put that back. And the reason is because many of us may not recognize when we're doing a trade in the market or we have an algo strategy, we are building strategies to take buy signals, scaling or trailing, defining a risk reward method, whether it's 1-to-1, 1.45, et cetera, et cetera. But if there's not enough trading, or if there's not enough wild swings in the market, then how the heck can we anticipate to make a lot of money or to ride a trend? If right now, I just wanted to point out, while I was finishing my thought process here, while I was at the Traders Expo, I had made mention, it's ironic that we are with the euro currency, it's very difficult for traders to make money day trading in the euro currency because we are sitting at almost a historic low ATR. In fact, I went back on the other screen, and if I go to format symbols, and this is what you can do for yourself to validate any statement. What is the average? So we're going back 20 years, okay, and I'm going to hit OK. And for the record, this is very interesting because I think 3 markets are very dynamic for trading: gold, crude oil, and of course the E-mini S&Ps, okay? When the ATR went up on crude oil, I'm trying to make a 2-minute algo system, but I can't seem to get it to make trades. Is there a way to troubleshoot this? Yes, absolutely. I will share with you that in just a minute. So if it didn't take trades, one of the things that you needed to format was your risk factor. So perhaps it won't take a trade if you don't have the right risk factors. So I just want to go first and foremost in the format for today is how do you get the most out of John Person's indicators? Number one, what's so special about them? And how do we apply them to maybe give us a better edge in developing trading programs using the Algo Optimizer? Several days ago, and quite frankly, for several weeks now, I've been high and mighty on the Russell, and I believe that the Russell should start to outperform. We did a 3-day seminar here in Palm Beach Gardens, as I mentioned, and one of the things that I told people, if we start to see the Russell outperform relative to the other two markets, you're going to want to start to develop a long-only Russell program, or at least if we see an expansion and a breakout on the Russell, because number one, the Russell has strong seasonality going through the end of the year. It's called the January effect, number one. And number two, it is starting to build a base of interest and volume, and the whole concept of the Russell is about growth. A lot of the companies in the Russell do not pay dividends. You have large exposure with regional banks, large exposure with small cap energy, and which, by the way, energy, while it might not be doing very well right now, it enters one of the best times of the year to start investing in less than 30 trading days. So sometimes fund managers know this, and they'll start to deploy capital to work a little bit early. So if we start to see the energy complex, the financials, and again, another component is small cap biotech, then that's the three missing links as to why the Russell's been held back. A lot of people wanted exposure into blue chip, large cap stocks for that extra dividend yield, because we were many people, many fund managers, many people who control trillions of dollars of money were expecting the world to implode. We were going to go into a recession. The trade war with China was going to be a disaster. And the Federal Reserve, as we came into the beginning of the year, don't forget, had raised rates. And now, again, the Fed has lowered rates and been very accommodative in the stance. So we've got a backdrop of an extremely accommodative Federal Reserve. Jerome Powell spoke today, and I don't want to go through the economics of things, but how you can validate whether or not you can change and when you should maintain an algo program has a lot to do with this one simple tool right here called average true range. And if you struggle in the market, and the first thing that I mentioned, and I do this a lot, and I just want to make sure it's done again in this recording. So the average true range trends on a 10-day basis, and you can see that, in this case, the trend is mostly to the downside, right? So there's not a lot of activity, at least from a day-to-day perspective in the market, because it is a trending value, right? I mean, you could clearly see it, how it kind of makes lower highs and lower lows. And when you get through a breakout, that's when you can anticipate if it breaks out of a trend of a period of low volatility or a low ATR, it may run into a period of expanded ATR. So I always like, rule of thumb is to look at least a 2 to 3 day trend, a 2 to 3 day trend. 1 day ATR could be because of a economic report or a Fed statement or a central bank statement. But when you get 2 to 3 days of expansion of volatility, that's when it's my first sign or clue I need to maybe address my system. So if I have a strategy in Algo 17, for example, that suggests tight range, take a few ticks profit. So, you take a look at this and you got, at this point, going from April through June, the ATR is, at that point in time, I even announced, I think it was in April or maybe it was early May, that was, I think, the lowest daily ATR that the euro currency had entered since its inception. And so I had made this comment back in Las Vegas at the Traders Expo the other day, and I don't think, it was, the show was, I think there were some sponsors in Forex, and they didn't probably appreciate the comment because I was speaking on behalf of the CME. You know me, guys. I don't discriminate. I trade the British pound, which we have a strategy in the pound because it has better daily trading ranges. It's tough to get blood out of a turnip. And here's the thing. You can get blood out of a stone. You can squeeze it, but it only might be 2 or 3 ticks. So the energy, the risk, and the amount of trades to make a profit in a low ATR environment is very difficult. And one of the things you'll have to do is A, you're going to have to increase your lot size. B, increase your holding period, which means maybe take longer term trades overnight. But day trading, if that's the market, and most people assimilate Forex with day trading, right? So the moral of this story is that if you're going to develop a strategy, you need volatility to a degree, right? And so we are looking at a market that is not at its historic low yet. It's about 10% above its historic low. Remember, the euro currency, when it first came out, was just subpar, meaning 1-to-1. A dollar, it was like 98 cents. 98-cent euro bought $1 US way back in the day. If you watch CNBC, it was like way back in the day when even Mark Haynes was still with us, who many people may not remember Mark Haynes from CNBC. And again, the personality lineup has changed so much on CNBC. Most of them are over at Fox now. But anyway, just a little history lesson. The euro currency, if you take a look at where's the ATR now and where was the price then, here's what's ironic. When the market was, when it first came out, it had, truthfully, there's 91 cents in here, 88.91. This is probably, if I may be so bold, format symbol. Let me double check one item here. We've got 20 years back. That's good. Scaling. Let's see. We've got linear. That's good. Fixed. That's okay. So we can see everything. And exchange time, and it's all good. All right, perfect. All right, just want to make sure that we were on the same page here. So the moral of the story is, here's a product that's trading a lot more expensive than it was then, but the ATR, or the daily fluctuation volatility, was like 80 cents, 70 cents. I mean, at one point, it dipped mildly to around 55 or 60 cents. Quite frankly, we've not been this low at around the 40 level since in its entire history. So what gives? And no one wants to trade the euro currency. There's not a lot of public trading in the market, et cetera, et cetera. I think it's Brexit. Maybe there's more stability in the dollar, and I think a lot has to do with the negative or real rate return of interest rates. After all, who feels compelled to want to be in the euro currency when if I have to park my money in a bank, I'm going to pay interest for them to hold my money? So I think that might be part of the whole concept of what's going on with the lack of volatility in this market. So I don't want to get too much more other than, gang, find out everything you can about your market. Are you trading in a historic, just like with options? And on Thinkorswim, we can look at 52-week historic volatility compared to IV. If you're an options trader, you know what I'm referring to. Average true range and how a market trades. Remember what I just taught you. If you take the ATR and you see a market that breaks out and you give it 2 to 3 days and see if a trend develops, now all of a sudden I've got a very systematic program that doesn't trail, it doesn't have a big profit target, it's just got a mild profit target because the market has been in a declining ATR environment. This was back in 2014. When the market starts to break out, if the longer the period of contracted ATR, the longer the period of expanded ATR. That's a theory. And you know what? It works pretty well too. ATR, by the way, just to give you a lesson on average true range, it's vital to understand this type of analysis if you're developing algo strategies. When you go into a period of expanded volatility, that's when you got to kind of recreate or maintain your trading models. And that's been the secret to the success and how I've been training guys, ladies and gentlemen, to utilize the Algo 17 program. So once again, I just wanted to demonstrate, look at the ATR. When you see the market, just like any trend line, break out after a prolonged period of declining ATR, you can probably identify we're going to an expansion phase of ATR. So here we fast forward to where we are breaking down in 2019. Remember that was 5 years ago, man, and it didn't last too long. So two things you want to walk away with knowing. A breakout in ATR from an expansion to a contraction phase, you can use trend line analysis, just draw it off the highs, right? And if it breaks that high, it's going to break out. You go from a contracted period of volatility to an expanded volatility. Now, another thing I want you to all recognize is that when it comes to ATR for most markets, the average true range does not help identify up or down markets. It's kind of weird, except for one market and one market alone, the S&P 500. Let me get to that point in just a second. You notice it might be hard. I've squinched the graph down a little bit, and you can see it. It looks like a pulse, but we went from a period of, look what the ATR is down over here through that 13 through almost late 2014, Here's the period of low-end volatility, and then we went through a period of expanded volatility. So, by the way, notice that the volatility kind of stayed at that high-end level in down markets, in up markets, in choppy markets, down market, and in up markets. So volatility was not helpful. Expansion of volatility was not helpful in determining trend direction. It's helpful in determining holding period and position size. It's important for ATR for holding periods and position sizes, okay? So that's what I wanted to make mention. And so when we go through for example, later and earlier this year with the E-mini S&Ps, now this is a daily chart again, and I'm just focusing on ATR right this very second for the markets that you would be looking to trade with, right? So looking at ATR, by the way, oh, wow, we must have been already cheating and using ATR trendline analysis. We went through a period where historically we just don't normally get to a 96. I think there was a 10-day ATR of around 96 points. Or maybe, no, one day was a 96-point day, and the ATR had popped to just about 90, I think it was. So we do get these little spikes, but notice the difference in spikes in volatility. Spikes in volatility in equities, and especially the S&Ps, that's different. A spike in volatility generally comes at the expense of declining market environments. Why? The market sells off a lot faster in equities, deeper corrections, everyone's heading for the exit door. And in bull markets and stocks, they generally go up very teeny, small range bars. So in equities only, my observations is that when we go through a period of contracted volatility, it generally helps to define a more bullish market environment, calmer. It's one of the very few markets that ATR will help you to determine trend direction and market condition. I hope I'm like not just Waterford crystal clear, but maybe Baccarat crystal clear on this. And so with that theory, that's really the main number one reason, because buy signals and market bull trends act differently than key reversal sell or bear market conditions. And that's why we developed or started to develop the algo optimizer from the day one, in the sense that we were looking for ways to trade and develop trade systems. So in the live trading room, if I may get to that page, bear with me a minute. Here we go. All right. In the live trading room, this is the new version of Algo 17. So Algo 17, I think Jay said I keep referring it to 18 because the new version says Jay Person, the Algo 17 Extreme version 2, but number 18. Why? Well, we should be calling this like Algo System 29, I think, or maybe 34. This is I can't remember how many releases. And so instead of just referencing a new version, it's I don't know. We just liked the 18. It's also a sign of prosperity, by the way. And so just to let you know, instead of just saying version 2-A, that might have worked. 18 is also a very auspicious prosperity number. And so we thought that would be kind of great, hidden, giving everyone positive karma their way. All right. So this is the new version, or the latest release. And I know we've done this before. I just wanted to make sure it's recorded and you guys see this on the Pug Room. You know, you can optimize the best time of day. You can override and say, I don't want to take any trades until after maybe 9:15 in the morning, right? Exit for day traders, exit end of day. We can go through and do a position sizing model. And so what we're looking at right here, I just updated this for the live trading room. This is a strategy that goes back in the last 4 years, coincidentally, 4 years in SPXL. This is a long-only model. It doesn't take shorts. Long-only model. Why long-only model? Could someone answer the question, what does the market generally do most of the times, except for the period in 1929 to 1932, except for the 3 days in 1987, except for the 2 months in 2011, except for maybe 4 months in 2009? What do you think the market does mostly on average in equities? Jay says it goes up. Wow. Well, let's see. If a market generally goes up, then maybe I should stack the odds in my favor and develop a long-only strategy. And perhaps, since we have inverse ETFs, do a long-only, unlike SDS, because remember, markets and equities go down a lot differently than how they go up, right? So with that said, the latest version takes in account of different periods of volatility. And again, so if we take a look at this trade from 2017, and this is a leveraged ETF SPXL, and you can see the big decline that occurred that we came into as we started 2018, yowzer. We came into the year in 2018 in September, and it kind of missed everything. It took a long, it got out, it got an owie. That's no pun intended. It took another long, it quickly got out, and it missed the entire downside or drawdown back in December. It quickly went right in on the long right after Christmas. Anyway, I'm going to go through it. I shared this with the live trading room the other day, since there may not have been a whole lot of people in the room. I knew we were doing a pug. I felt, you know what? I'm going to share this strategy because this is one I've used for myself, and I finally got around to adding it into the live trading room. So when you come into the live trading room, this model right here is on that screen. So moral of the story, this is, if I'm not mistaken, I'm pretty sure I updated everything. There it is, version 18. So all of our models, and I believe crude oil, format strategy, and it is it's Algo 17, version 2, but the 18th one of good luck. All right, so just make sure we're all on the same page. All right, so 18 is just auspicious. If you don't have the version that has 18, please download it, because here are the dynamic changes that came with this particular program. All right. Let me just go through and we'll hit the program changes that came through. Were setting a stop at even or a few ticks below break even when we got out of partial profits. Some of you may remember the trade might have been in a winner and it got out of half, and then it wouldn't get out of the damn thing unless it got stopped out or a reversal, and we were giving back profits. And so this model suggests we overrode that, and we said, you know what, if we get out of half at the profit target, which in crude oil, that would have been the profit target, the blue line, right? If it didn't get out of everything, and remember it's trailing, it's like I wanted to jam a protective stop because I don't want to take a loss on half the position. If I took a profit on one, why would I entertain taking a loss on the other half? So we have this emergency code of line written in, and guess what? I don't know if it works or not. You can optimize per your particular market. The other aspect, and many of you are familiar with the fact that we have the last conditional change for stops, a dynamic exit, which is a combination of last conditional change values from a trailing stop functionality with ATR, average true range. It's a combination of ATR as well as last conditional change. So the next one is this compression exit, which is a combination of three things: last conditional change, a formula that includes ATR, and as well as a formula that adds time. In fact, not just time, what a compression exit is, but also when the compression exit would even be turned on. The compression exit won't be turned on unless we go 4.5 ATR values, and then the compression exit's going to kick in. So that was a new function that was for Algo 17 version, the latest version. The other neat things that we added here, which really made sense, was, again, this little function here. We can optimize whether or not we want a moving average based on a high, a low, a close. And that's why you see HLC underscore 123. Because if you say, well, I want to take a buy signal, PPS buy, but I only want to take a PPS buy if it breaks out of, in this case, it's a 2-period moving average based on the close. So that's kind of like, all right, it's got to be a 2-period moving average, which isn't quite pivot, but it's kind of weird, and it filters out, and it does not use a last conditional change. So in the last 4 years of volatility, I think the SPXL, at least looking at dynamic moves up and down over the last 4 years, by the way, the reason I endorse this program for the trading room is it kind of has a decent, it's highly filtered, it has an edge to the long side, it has a decent looking equity curve, and I think it's not that bad. So whether or not you want to use it, if you have Algo 17 Extreme, we've posted this in the live trading room. It's under other recordings, but if you're here with me now, this is being recorded. You can simply, I'll just scroll on down. You can see the 55% trailing, the scale out ratio function is at 0, so it doesn't scale out. In fact, all this functionality does because of equities is it trails a stop, right? It's holding period, and we go all the way down. Notice it does not take any shorts, zero sell signals. It's only longs. It takes the PPS. You'll see here we get on the long side. It only takes PPS. It doesn't take high closed dojis either, right? So that's another function that on an end of day basis, I think if you look here with a leveraged ETF, you might find there's a lot of bars that represent dojis because there's no real range between the open and the close. And that may be just not a function of being able to pick up good signals. So this particular model, by the way, has a max trading bars holding period of 34 days, 34 trading days, not 34 calendar months. That's 34 periods. So that's almost, if you think about it, the max bar. If there's a massive trend in the market and you don't get stopped out, how often do we see a trend before a pullback? And here's one right here. This happened in April. Nothing really happened. And then it knocked out, but it went right back in on a long position. It went right back in on a long position. So the algo optimizer, at least looking at this particular strategy, number one, when would I start to change this program? Well, first and foremost, I would re-optimize if we go through a contracted period of even further contraction of ATR. But since this is a long only, listen carefully to this now, it would be assumed that we are in a lower period. So here's where I think it's an interesting concept for everyone. With crude oil specifically, crude oil, we had a hell of a run this year. I mean, let's face it. Raise your hand if we had a hell of a run here. And you know, by the time I convinced everyone, unfortunately, we expanded and we changed, as we noted the ATR back in late May, early June. We noted, and I pointed this out. So that was June, July, August, September, October. That was 6 months ago. 6 months ago. I changed the format because the ATR expanded. And I said, we've got to adjust our trading models for this increase in expansion of daily ATRs. Then, I don't know, what was it, around the middle of September? And all of a sudden, I noted, hey, gang, the gig is up. We're starting to see a contraction in ATR. I mean, we were going from about $1.30 daily range every day, and we jumped up to about $1 or $2.79. I think there was a $3 range in there one day. There was actually an $8 move the day on that Sunday night when Saudi Aramco refinery was attacked, if you guys remember that. Let me go over and see if I can get a daily chart on that. It shouldn't be that hard. Cool. And, you know, I sometimes forget, if I may, format analysis technique. We got to go to ATR, format it, and then auto scale it. Okay. And then hit OK, and now hit close. There we go. So, I mean, I've already kind of done the work here. You know, you caught me with my pants down, so to speak, because when I teach you something that I do, if you don't see it on my charts, you know, it's nice to know that I practice what I preach. That's, I guess, the point that I'm trying to make, right? So we had a, back in May, what a coincidence, man. I'm noting that after a couple days, what did I tell you? After 2-3 days, we see an expansion of a breakout of ATR. That's when we know that we've gone from a period of declining ATR that we may be entering a heightened period of trading. And so here we had this whole summer. I mean, we got up to, I think it was right in here in August. There it is. That's the day. I think we had that day was more like the day itself. Now, again, this is an average true, a 10 period ATR. But I think somewhere in here we had like $3 ranges. It was pretty crazy. And, you know, if you think about the heightened period of ATR for a second, and you look at where prices are in the mid-50s, they weren't trading up to 80. There was no war breaking out. What caused this type of increase in volatility of an everyday occurrence? I just don't have the answer. I wish I knew, but that's the nature of the markets. My job is to teach you what to look for and how to be a smarter trader. And I think when you have the ability to take a buy signal and you get into the market and it moves, you damn well better have an exit strategy to take money off the table. It's interesting because some people feel they need to be in the market and they're guilty if they get out of a profit too soon. And I think even for myself, that buyer's remorse syndrome occurs, which is simply this. If I get into a trade and I get out a little early and it keeps going, I feel like, oh, I left some money on the table. So that's why I've always been, my style of trading and how I teach, to get in on a day trade with everything all up front and then scale out of a trade if I have to and trail a stop. So breakout methods. If you're in a breakout mode on a day trade, for example, I mean, if a breakout means that the market's already had a bottom and it's already had a trend established. So that means you're coming to the party late. So you've got to have some type of an actionable exit strategy in the marketplace. When you have an expansion of an ATR that goes from $1.30 to almost $3, man, we better be able to capture some of those trading ranges and the way the market trades. And so therefore, that's why the algo optimizer, I just wanted to point out to you, there it was. On or about October 9th, the market kind of broke down its expansion. And what has it done since? $1.55. We've seen a contraction in daily trading ranges. Interestingly enough, one of our students came for a mentoring last week, sat next to me, and I said randomly, in my humble opinion, in my casual observations, crude oil has about, on average in the last few years, about $1.70 ATR. He took that work, went to go back test me, and you know what he found? He says, John, not only was I did more research, and I looked at the mean, the medium, and the mode. Wow. Over the last 20 years. And do you know what the average daily range was over the last 20 years? The average daily range is $1.70. Now, I don't want to give, I'm not giving credit to myself for that. I'm just saying that I was back tested. My observations and trading style allows me to have that information in the back of my head. But boy, this guy took it seriously and did a complete Excel spreadsheet. And his name will remain anonymous unless he wants to own up to it and he can admit who he was. But I thought that was pretty cool that a student took the time to study the markets as you should. So at least you have testifiable evidence. So how do we make money in a market? With the algo optimizer. The best way to make money out of the market is by identifying, are we in wild ranges that we could let things run as a trade, as a trend? Or should we be getting out with small profits because the market's not giving us big wild ranges? Lastly, if you're coming in as a day trader in the market trading the algo optimizer, by the way, gang, here's another thing. If we come into the market, either we might miss a trade because the risk factor might be too great for the trade of what we've programmed. So we might not have the opportunity to get into the trade. if you have a buy signal somewhere around 878, let's round up and say 80, and your stop loss has to go down here, that's $500. That's 50 cents times, if it's 2 contracts, that's $1,000. Well, in this particular model, by the way, it says, gee, max trade loss on 2 contracts is 630. It probably isn't going to take the trade. So is an algo optimizer the best thing all the time? No, but it'll help you. It will miss some trades. It'll only take the trades that you want to take that you would normally take anyway. I want to get long on a buy signal, but within reason. True? So that's one of the neat things about the algo optimizer is that we can find out A, the best time of the day to trade, B, when do we end the trade? This is kind of an easy answer right here, friends, is because if you know that you're day trading during the open outcry session, why would you develop a program that trades at 3 in the morning when you won't be awake to monitor your internet connection? All right. So your risk factor, your exit strategy, your compression stop. Now, I just redid this model, by the way, gang, because over the summer, the compression stop exit didn't kick in until about, 8 or 9 ATRs. And now that we have a contraction in the ATR, guess what? The compression stop did. It also came down to adjust for those smaller intraday ranges. Okay? So that's what I think. Norm says, John, trading the 5-minute charts for the first 4 hours of the day, is there a way to monitor what time frame of ATR to watch to know it's a good idea to take profits earlier, or does it matter? Norm, that's a great question, sir. And I want to make sure I got that under our thumbs because we're running out of time right now. First and foremost, the ATR is based off an overall trend, right? And if you notice, I think when we're in a bull market for equities, I already answered this question. As equity markets go up, ATRs contract. So that's one. Another thing is, and it's not, and even in August, notice the trend was down and we had a wild period of ATRs, right? So that was pretty crazy. I think for day trading purposes, if you're in a smaller contracted period of an average true range environment, it makes it very hard to want to be scaling and trailing a stop. You're going to have to probably be able to take money off the table a little bit sooner and set, as you see, the scale out ratio right here is set at 0 for this model here in the crude oil. So at this point in time, until we get an expansion in ATRs, baby, this is the kind of norm that we're getting recently. You got to also, I want everyone to also follow this up. Sometimes we need to pay attention if you're a day trader in the market and you have a day trading system. You're saying take a buy signal. But what happens to those days when you wake up and you get this amazing trend in the market maybe that happened overnight, and then what we're left with is chop and slop? Now, in the last few days, you notice here with the model, it's been taking some pretty decent trades. But when you come in, it misses a lot of these big trades because maybe the risk is too great. So there's a combination of understanding we're only looking to trade within reason, within a defined risk, and the parameters of what our strategy will help us define in the market environment in which we are given. If we are given a market environment with expanded ranges, then you have the ability to maintain that strategy and say, you know what, give me out a half and then trail my stop. That might be important. If you know that we've got a period of contraction in ATR, then maybe just set a tight, maybe what is your average range in the S&Ps right now? If we have a ATR sub 30 points, if I may be so bold, and I'll put that back up. Let's see, where is it? Gosh darn it, there it is. Okay, so if we have the ES right now, and that's why I love this TradeStation layout, because I can immediately just go to my futures page, go up to ES and say, where are we at? Guys, ladies and gentlemen, we're at a 22 handle ATR, even with the volatility today, which was kind of unusual, right? There was a little headline news from Reuters that said there's no deal in China or the ag thing, and the market sold off just a tad, right? So look what we have. Today we had a range of 21.25 points. We are contracting more. And from what we've just discussed, in a day trading environment, man, we went from 96 points to 22 points. So what does that tell you? Smaller profits, shorter term holding periods, hit and run. Okay? Anyway, I hope today, I wanted to spend some issues because as great as everything can be created for a trading model using the algo program, we need to still do a little bit of homework and identify what is the trend environment we're in. What is the market condition we're in? And how can we massage or stock or at least stack the odds in our favor? A daily program like this. Guys, if the equity market 70% of the time goes up, long only. If we noted that the market in the equities goes up on a contracted ATR environment, guess what? I'm going to have to increase my holding period, or I'm going to have to increase my lot size to accommodate that. I hope this answered some questions for everybody. And again, some of the major, at least giving you some strategies that you can and settings that you can apply to the version 18 if you have not been in the live trading room, specifically using SPXL. And again, just identifying and helping to point out what the dynamic changes were. We never were capable of optimizing whether we should use a moving average of a high, a moving average of a low, or a moving average of a close. And now we can. All we have to simply do is just put in 1 to 3, for example, and a jump rate of 1. And what is that going to do? I'm going to rerun this optimization in front of you right now. This suggests I should use, if I'm, well, I don't have PPS turned on for sells. So you know what? Let's just do it. Let's put in 1 for sell signal. Should I take a sell signal, yes or no, over the last 4 years? Would it improve my bottom line? And if so, should I filter out that sell signal by using a moving average? And if so, what's the length of my moving average? At least 2, because 1 is not a moving average. It's just a value. And if this is a daily chart, maybe 20, and then increment a jump rate of 1. So it's going to start testing a 2 period, a 3 period, a 4 period, all the way up to 20. That's a 20 period moving average. And then what type of moving average? If I'm looking for a sell signal, I would bet it'll probably come up with either a breakdown of a moving average of the low or a moving average of the close. And that's how we hit OK and then optimize. So that's one of the neatest functions that we did, was to break down what kind of a moving average should we utilize, if we should utilize one at all. So this actually zipped through a little too quickly, but the performance graph actually went a little bit better by taking shorts, and it identified, and you can do that yourself. As you can see, let's double check the settings here, and it said on a PPS sell signal, there, a 20 period moving average of 2, the low. So it did do a pretty good job in filtering out, only take sell signals if it breaks below a 20 period moving average of lows. Pretty cool. Thank you all very much for attending, and I hope today really gave some insights on how to utilize market conditions and apply them to the Algo Optimizer program. Thanks everybody, and for those in the live trading room, we'll see you tomorrow. Thanks again.